Hello and welcome to AI Market News by LM. The US stock market has been on an absolute tear, with the S&P 500 hitting its longest winning streak in months. But with so much uncertainty just bubbling under the surface, the big question we're digging into is, can this rally actually last, or is it just setting us all up for a major fall? Let's break it down. Right now, the mood on Wall Street is undeniably positive. We're seeing this wave of optimism just sweep across the markets, pushing the major indexes higher and higher day after day. And what's the big driver behind all this excitement? Well, it's a 7-day winning streak for the S&P 500. We haven't seen a run this long since way back in October, and it has Wall Street absolutely buzzing. So what's fueling this fire? What's really behind the sudden surge of confidence in the market? Okay, let's look at the numbers from April 9th. We're seeing green across the board. The S&P 500 and the Dow both climbed over 0.5%, and the tech-heavy NASDAQ, it led the whole pack. So this isn't just one sector doing the heavy lifting, it's a really broad market rally. But the real question is, what's holding it all up? Well, it turns out this entire rally is basically hanging on a single, very fragile thread, and that's hope. The market is running hot on the idea of a best-case scenario in the Middle East, pricing in a durable ceasefire and even potential peace talks. And that, of course, leads us to the critical question. Is all this optimism actually justified? Is this rally built on solid ground, or is it more like a house of cards just waiting for a breeze to knock it over? All right, let's start our reality check with the very news that's lifting the markets in the first place, those fragile hopes for a ceasefire. First, let's take a look at the Strait of Hormuz. This narrow waterway is an absolutely critical choke point for global energy. We're talking about roughly a quarter of all seaborne oil passing right through here. Any disruption sends massive ripples across the entire global economy. And here's where we see this huge disconnect between the headlines and what's actually happening. While markets are celebrating a ceasefire, there's effectively a blockade of the strait still going on. On April 8th, just 7 ships, all linked to Iran, passed through. Normally, it's about 135. Shipowners just aren't buying the good news. They're still way too worried about mines and security risks. This tells us the foundation for this market optimism is shaky at best. But okay, let's just say, for the sake of argument, this ceasefire holds and tensions ease. The market still has to deal with some pretty serious economic headwinds that were brewing long before any of this recent conflict. For instance, let's talk about economic growth. Before any of the recent global drama, the US economy was already hitting the brakes pretty hard. The final numbers for Q4 2025 show GDP growth at a mere 0.5%. And what's worse, that was revised down from an already weak 0.7%. That's a clear signal of losing momentum. And at the same time, inflation has been incredibly stubborn. In February, the core PCE price index, and that's the inflation number the Federal Reserve watches most closely, it rose 0.4% in a single month. This shows us that even before the recent conflict sent energy prices soaring, underlying price pressures were already uncomfortably high. And that brings us to the next big test for the market, the March inflation report. Economists are bracing for a massive 0.9% jump in the Consumer Price Index, or CPI, for the month. If that number holds, it would be the largest single-month increase since 2022, and it would be the first real piece of data showing the impact of that recent energy price shock. Jeff Roach from LPL Financial really puts it perfectly. He points out that even before the war, inflationary pressures were already strong, especially in places like healthcare and financial services. So the recent geopolitical shocks haven't started a new fire, they've just thrown gasoline on one that was already burning. Okay, and finally, let's zoom in on a specific risk that's brewing inside the tech sector itself, what we're calling the double-edged sword of artificial intelligence. So on one hand, AI is seen as this ultimate growth engine, right? We see Meta signing a massive $35 billion deal for AI computing power. That's a huge bet on the future. But on the other hand, for a lot of established software companies, AI is seen as an existential threat. And that fear is showing up in the numbers. The iShares software sector ETF, ticker IGV, has been hammered this year, down over 27%. As Kevin Karn of Washington Crossing Advisors explains, there's this new fear that AI agents could just make a lot of existing software business models totally obsolete. This is forcing investors to completely reevaluate the entire sector, trying to figure out who the future winners are and who the potential losers might be. So given all these different things pushing and pulling on the market, fragile geopolitics, stubborn inflation, and this turmoil in the tech sector. What should we be watching for next to see where the market might be heading? Well, there are 3 critical events to keep on our radar in the coming days. First, the US-Iran direct talks on April 11th. That's a key test for that fragile ceasefire. Second, all eyes are going to be on the March CPI report on April 10th for that big inflation read. And third, we've got a wave of key corporate earnings. From banks to semiconductor giants, we can track all these events on a detailed economic calendar like the one on investing.com. And so it really all comes down to this. The market is clearly at a crossroads. Are we witnessing a classic bold trap? A temporary rally before all these underlying risks pull everything back down? Or is this the shaky, uncertain beginning of a more sustained recovery? The next few days are going to be absolutely critical in answering that very question. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks for watching, and don't forget to like and subscribe.